Praveen Chauhan, and we have our investor relation advisors SGA on this call too. The results and the presentation are uploaded on the stock exchange and the company website. I hope everybody has had a chance to look at it. Today on this call, we would like to talk about three key themes. One, our recent developments, tools, trends in the industry, as well as our performance and outlook for the year. Firstly, on the recent developments, I'm delighted to share with you that we have completed the construction of our new aerospace and defense plant at Jigani, Bengaluru. Soon, we will be shifting the lines from our existing facility, apart from adding the new machinery as well. This would happen in a staggered manner as per the customer approvals, and we expect that this will be completed by end of March and will be fully operational towards from the 1st of April onwards. Construction of this plant has been completed in a record 9 months' time ahead of the schedule. It's a greenfield project. This facility is 4 times the size of our existing aerospace and defense facility. As we speak, we are fully utilizing our current capacity, and this facility would give a fillip to our growth in this segment. At a full capacity utilization, given the kind of components and the mix that we have in aerospace and defense, we expect that we can achieve a top line of about 3,500 million from this facility. In addition to the covered area, we have access to more land for further expansion at the same location, which might include an expansion into special process as well. I am also very proud to share that we have been lauded by our customers, mainly our customers like Bajaj and Toyota, for our quality performance. ESG has always been in our DNA since the very beginning, and we have been awarded Hero Next Sustainability Award for the year 2022. Now, talking about the industry, in this period, the domestic market has been a bright spot, whereas, as expected, exports, as we had guided previously also, has been flattish. In general, Q3 happens to be the weakest quarter for us as model change comes in at the year end, and also a lot of customers would undergo almost 1 week of block holidays for the maintenance, and our plants will also be, a majority of our plants also follow the same. The domestic PV sales are clearly on the growth path on the back of easing of the semiconductor supply and also introduction of new models, with also robust demand coming from the domestic market as well. However, domestic two-wheeler demand, especially the ICE two-wheeler, has been a weak spot, while two-wheeler EVs, which have been started doing well. Coming to our performance in the quarter, we delivered a top line of rupees 5640 million with a healthy growth of 16% on a year-on-year basis. This growth was largely driven by the domestic market, whereas our international business was flat. Having said that, our international business saw some recovery compared to Q2. On the export side, our aerospace and defense business has been strong. We expect the exports to start becoming normalized from Q4 onwards, and we expect a very strong growth in exports in the coming year as well. Sales of our auto segment for Q3 went up by 10% year-on-year, largely driven by the growth in the domestic market. This segment contributed around 89% of sales, which includes our XEV, in the Q3FY23. Of this, 6% of sale came from auto tech agnostic and another 5% came from XEV products. In contrast to, in Q3FY22, a combination of auto tech agnostic and XEV products was only 7%. So this has gone up by almost 4% for us. In terms of Q3FY23, sales mix for auto segment covering both ICE as well as xEV and tech agnostic components, 36.2% of our sales were from motorcycle segment. Scooters accounted for 13.3% of the top line, where increasingly the contribution has started coming from the electric scooter. Commercial vehicles accounted for about 12.5% of the top line. A significant portion of the sales for our Swedish subsidiary is in this segment as well. In CVs, we witnessed a degrowth of 5% on year-on-year basis, but performance is looking better on a Q-on-Q basis. Passenger vehicles accounted for 24.7% of the top line, and we are seeing strong traction here, especially with addition of new customers like Tata Motors. We are expected to do much better. We will be doing about approximately about 1 million connecting rods for Tata Motors in the year to come. Our non-automotive segment grew by about 50% in the quarter, which is in line with our expectation. And in our current sales mix, aerospace contributed to about 4.7% of our sales, registering a strong growth of 92% year-on-year in the quarter. We expect this momentum to continue, and we expect that we will exceed a top line of rupees 900 million for FY23 for this segment. We have a very strong order pipeline as well. Several of our products are also under various validation stage. Agriculture sector accounted for about 3.2% of our top line. Off-road sales were in the region of 3.4%. This is slightly muted because most of this is going to the exports, and things have started becoming better now. We expect a very strong recovery in this segment for us in the coming year as well. This was primarily because this segment and the customer was hit by a chip shortage for a long while, but now things are becoming normalized. So we expect a strong recovery in this segment. And remaining 1.3% of our top line came from few other segments. Coming to our order pipeline, as of 31st of December 22, our order book was quite healthy. And with our order book of new business with an annual peak revenue stood at about 15 billion, rupees 15 billion. So potentially this business, Auto ICE, is contributing about 7.34 billion, which is about 49% of the total order book. Auto Technologic is about 4.52 billion, which is 30% of the total order book, and non-auto accounts for rupees 3.16 billion, which is 21% of the overall order book. There has been order inflows from all the sectors, and in terms of geographic mix, we are seeing recovery in our international business, and specifically we have added a lot of business from North America. With the trends which are emerging in our sales mix as well as our order book mix, we have made encouraging progress towards our long-term vision, which we had set earlier with respect to the revenue mix. Our long-term target is to improve our contribution from non-auto segment to 25% and auto tech agnostic xEV to 15%. We have made a steady progress towards this target, and for 9-month period of FY23, non-auto contributed to 11%, whereas auto tech agnostic xEV contributed to 10%. These numbers are even better when we look at the Q3 numbers. Shift that we are witnessing in the domestic two-wheeler industry from ICE to EV augurs well with our transition. Also, our sales mix will further improve once our new aerospace and defense facility mentioned earlier will start operations from the month of April. Going ahead, we are very confident that in terms of overall performance, we will grow by between 15 to 17% on a year-on basis for a FY23. We are geared towards even a better FY24 as our domestic business continues to remain healthy with addition of all the new businesses that we have acquired in the XEV space will start yielding results. On the international side, we are seeing green shoots in our auto business as well. So with the easing of the semiconductor crisis and also to an extent normalizing of businesses in Europe, we see that our export business will be back on growth track. We are also seeing a strong demand from aerospace and defense side. I now hand over my further portion of our presentation to Mr. Vikas Goyal, our CFO. Vikas.
Yeah, good morning, everyone. I'll talk about the financial performance of the company during the quarter and for the year-to-date period. First, if we look at the quarter 3 of FY23, our total income stood at 5,640 million in this quarter as against 4,868 million for the last year's Q3, which is a 16% growth on a year-on-year basis. Our international business ended on a flat note on a year-on-year basis. However, the growth in our domestic sales outshone this quarter, and we were able to grow on an overall basis for the total business. The gross margins improved almost 2% due to softening of raw material prices and the sales mix change. We expect to maintain, rather improve this margin going ahead once our international business starts inching up again. The employee expenses increased by about 15% on a year-on-year basis, which is slightly lower than the growth in the business. And other expenses were largely in line with the trend in the last quarter. Overall, our EBITDA margin in Q3 stood at about 16.6% versus 15.6% in the same period last year. The finance cost for the quarter increased to 161.8 million as compared to 134.5 million in the corresponding quarter of FY22, largely due to...
Sorry to interrupt. Sir, your audio is slightly muffled, so the audio is coming unclear. Can you switch to handset mode and speak, please?
Okay, thank you. Sorry. The finance cost for the quarter increased to 161.8 million as compared to rupees 134.5 million in the corresponding quarter of FY22, largely due to the higher cost of borrowing or the increase in the interest rates and also slight increase in the debt. Our profit after tax of rupees 313 million in this quarter as against 239 million last year. In terms of geographic sales mix for this quarter, the split stands as follows. India accounted for 69.2%, Europe for about 19%, USA 7.6%, and other foreign countries were 4.2% as a percentage of total sales. Looking at the 9-month numbers, total income surged by 22% year-on-year at about 17,331 million as compared to 14,237 million in the corresponding period of last year. For the 9-month period, the EBITDA stood at 2,942 million with a margin of 17%. The net profit for this 9-month period was at 1,129 million as compared to 949 million in the corresponding period of the same year, of the previous year. Our total debt stood at approximately 6,787 million as of December 2022. With this, we come to an end of our presentation and we'd like to open the floor for question and answers. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Siddharth Bera from Nomura. Please go ahead.
Yes, sir. Thanks for the opportunity. So the first question is on the order book. So we have again increased it slightly in the quarter. First of all, can you indicate broadly, is there any big order which is here, or is it largely spread across multiple customers? And second is, I see that we have added a PV xEV customer also. So possible to highlight any particular name here which we have added in the quarter?
Yeah, Siddharth, thank you. Basically, as I spoke in my presentation speech, this time the order inflow has been healthy and has come from all the sectors. A lot of business has come from aerospace as well. There is also addition of business in the aluminium forge and machine component. In fact, one of our new additions has been from an European, passenger vehicle car manufacturer who has given us aluminium forged and machined component for their upcoming EV project as well. So the traction is good on from all sectors.
Understood. So second question is again on the export mix now. So if we see the past, we had done about say 36 to 38% in terms of total revenues coming from exports, and currently after some recovery we are still at about say 30% in the quarter. So you highlighted we will see some improvement even from these levels. So but will it be fair to say that by when can we sort of go back to the earlier levels of export mix, and any particular order which we should start expecting execution next year, and any growth outlook if you have for the export business next year?
Yeah, export, we had a couple of challenges, specifically overall exports, as we had communicated consistently in our previous earning calls also, that right from the beginning of this year, because of the reasons that all of us are aware of. One was chip crisis, second one was Ukraine war, which also further led to the energy crisis in Europe. There were challenges, and we had expected that the overall year we will have a flattish revenue, but we could end up slightly lesser than flattish revenue. But as we speak, you as demonstrated also, the Q3 has started showing the recovery, and I expect further recovery to happen in Q4. But normalcy probably we will start looking at a better mix and a better towards going to again 35-36% starting from the Q1 of the next year. So while overall we expect that, because whatever order that were in the pipeline will start getting, which also includes some business growth in off-road sectors. We expect that because we have developed several of the components for this customer, which is now all getting into the production. We are also expecting a good growth coming from aerospace and defense, which is aerospace is mainly into exports. There are a couple of projects which is going to start production one is to North America and one is to Europe on the connecting rod front as well. So overall, I would say, and xEV customer, we expect that the production to start towards the end of this year, the mass production. So overall, we expect that exports starting from Q1 of the next financial year should be back to our normal level of between 35 and 36%. So added to this, even our Swedish facility, which has seen a degrowth as indicated earlier also, because one is overall Europe productions are slightly down, and second one is because of our own customers' decision to de-risk their business and change the product portfolio. So now we are consolidating all those product lines, and the production is getting consolidated. So we expect that next year even our Swedish subsidiary will be back to the normal production levels, which was similar to what we had in the previous year. So overall, I expect that this would definitely benefit our international sales.
Got it, sir. And lastly, sir, if you can also highlight in terms of the growth outlook, while organic growth we should improve, any other areas like acquisition or any other inorganic areas also, do you think can be a potential area you would look forward to?
Yeah, we expect that, we are also part of ACMA cluster where we look at a lot of startup opportunities that come in our way. We are also open to, actively we keep evaluating opportunities that come in our way. As we speak, our areas of interest include aerospace and defense. We are also looking at some technology startups. So while there is a lot of interest, but we are also very cautious in what we choose and pick. Sansera is an engineering and technology-driven company, so we also look at various, lightweighting materials, opportunities in that, opportunities in the railway sector. So defense and aerospace is definitely on top of our list, and whatever we do, as I have also communicated earlier, we will not do anything which is very big, and like last time also we had done an acquisition which in overall scheme of things would be a strategic fit to us, but would not exceed, say, a capital outlay of more than about 100 crores. So while we are looking at these opportunities actively, but nothing is still firm.
Mr. Bera, sorry to interrupt. Could you please return to the queue? There are other participants waiting. Thank you. Ladies and gentlemen, we would request you to please limit your questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up question. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. A couple of questions from my side. One is with respect to the aerospace facility which has come up. What are the timelines we are looking at from perspective of ramp up, and by when do you expect to reach the full capacity, considering that we have a good order book on aerospace?
Yeah, Dinesh, morning. Basically, this facility is now fully ready. Partially, we have started shifting the existing machines. The new machines have also started coming in. We expect that we should have the full approval from all our customers before this financial year end. So in most probability, we will start commercial production post our approvals from the 1st of April FY24. So I expect that, this facility, this is dedicated to both aerospace and defense. 2/3 of this facilities is meant for commercial aerospace, and 1/3 is specifically kept for defense, where we have separate access. Everything is, separately built up so that there are no mix of commercial aerospace and defense facilities. So this we expect that, given the kind of traction that we have, we don't think we will have any spare capacity left in 3 years' time. So in my expectation that we should be full in 3 years' time in the facilities that what we are expecting to create. There is a lot of traction both in defense as well as aerospace. Commercial aerospace.
Okay. And you talked about having excess space available. So can we replicate the similar size capacity, or what can be the future expense?
Yeah, we have this overall space that we have access to is for about 10 acres, and in that we have built in the area of about 4 to 4.5 acres. And we also an intent to build a special process facility, because aerospace further growth and acceleration can be achieved only if you have an in-house special process facility, which we have also done this for our aluminium forged and machine business. We have created a full special process facility in our plant 11 in Bidadi, but that is limited to auto application. So we would like to replicate this in a much bigger way for aerospace, for which we have kept about 2 acres of space, and another 4 acres is available for a similar size of facility, in fact slightly bigger, because when you replicate facilities, you don't need to create all the common amenities. So I expect, we can create another 20%, 120% capacity in the space that is available to us.
Got it. And second question pertains to the export business. The pressures which we are seeing in exports, is it still to do with inventory restocking, or you are also seeing cut in production schedule? And in that context, how does the fourth quarter production schedule look vis-a-vis third quarter?
No, I would say that fourth quarter would be very, very similar to in terms of exports. We will see a growth in terms of exports from the fourth quarter onwards compared to even the third quarter. But there are a couple of factors. One is in terms of inventory correction, most of it is over now. There is also easing of chip crisis, what we can see. So things have started becoming normal, so we expect that starting next year we should be back to the growth trajectory of exports. We also have new programs which are starting in exports.
Got it. A few more questions. I'll call back in queue. Thanks.
Thank you.
Thank you. Our next question is from the line of Devesh Kayal from Monarch AIF. Please go ahead.
Yeah. Hi, sir. So out of this 37% revenue share from the motorcycle business, how much would be domestic and how much would be international?
In the motorcycle segment or in the two-wheeler overall?
In the motorcycle specifically.
Okay, I'll give you that. So overall, if you look at the exports, would be about. Just give me a second. Okay. Yeah. Any other questions?
Yeah, and I wanted the 9 months CapEx. How much CapEx we have done for the first 9 months, and for the full year, are we on track around 250-300 crores? I think that's what we had guided earlier.
Yes, we have done about 185. Vikas, can you take this?
Yeah, it's about 185 crores.
Yeah, and we are expected to, because our order book is good and all our projects are on track. We have also adding capacity on our aluminium forge press lines, because all the 3 press lines are fully booked now. We have about 58 component orders from 13 different customers, adding to a total annual revenue of about 115 crores. So there is a good traction. So we are on track for our capex addition. Thank you.
Okay. Yeah, answer on that motorcycle.
See, 27% is domestic motorcycles and 8.2% or 8.3% is exports.
Okay, sir. Thank you. Thanks a lot, and best wishes for the future.
Thank you.
Thank you. A reminder to our participants, if you wish to ask a question, you may enter star and 1. The next question is from the line of Jyoti Singh from Arihant Capital Markets. Please go ahead.
Yeah, thank you for the opportunity. Sir, my question is on the your guidance side, that you have guided 15 to 17% growth we are expecting for FY23. So as currently in this quarter we done it around 16%. So as we are doing pretty good on all the segment front and on the expansion side, so can we expect more than this, or we are expecting similar?
See, while a lot of sectors like our exports is coming back to normalcy, and the aerospace is doing well, the passenger vehicle segment is doing relatively well, but there is still stress in the domestic two-wheeler ICE sector. So there is also this OBD2 changeover that is going to happen, and with that, there is some production inventory adjustments that is expected to happen. So considering all these things, we expect that we will end up in whatever range that I have communicated. We will one thing for sure, that we would not let go of any opportunity, whether it is in increase in share of business or increase in this thing. So this is what I expect.
Okay. And sir, my second question is on the scrappage policy. So as government has mentioned in the budget, so it will be benefit for us also?
If there is an overall benefit, because our presence is there across all the sectors, across commercial vehicles, passenger vehicles and two-wheelers, everywhere. So if there is a policy which is going to be beneficial for the overall auto industry, we are also bound to get, because our domestic presence is quite strong. So we will also get benefited out of the policy, definitely.
Okay, that's it from my side. Thank you, sir.
Thank you.
Thank you. Our next question is from the line of Basudev Banerjee from ICICI Securities. Please go ahead.
Thanks. I just wanted to understand, sir, I see your exports, and you earlier also commented that sequentially absolute export revenue was flat to slightly up only. And as per your PPT also, export mix has recovered. Domestic passenger cars have been steady, and domestic EVs have only been moving up. So if I remove all this stuff, so the prime driver of sequential revenue decline of 12% seems to be domestic ICE two-wheelers. Is that the right assumption, sir?
Yes.
So from that angle, if you can highlight how much has been the actual revenue reduction sequentially from domestic two-wheeler ICE, scooter, motorcycle combined, and is there any change in market share or wallet share of the corresponding customers, or any one-off in that where any specific OEM had some supply issues? If you can highlight on that aspect.
No, actually there is no change in any share of business, particularly in any of the two-wheeler sectors, while our share of business is growing in terms of TVS, where we have had business opportunity which came our way a couple of years back from when they decided to move into India from China. So that is still getting consolidated and revenue is growing, but we don't have any asset change in share of business. But with newer models getting added across our customer profile, we are expected to get slightly better share of business, because in most of the newer models our presence is there. So it is only going to get better. But as of now, sequentially, you wanted a sequentially, what is the change in two-wheeler?
Domestic two-wheeler ICE revenue.
Yeah, overall sequentially from Q2 to Q3, this year, Q2 to Q3. I'll just give you the number first.
Sure, sir.
So there is a loss of about 30. There is a gain. In fact, there is a slight gain in domestic two-wheeler auto ICE segment. Close to about about 30 crores is the total gain from sequentially.
Sequentially, your total revenue is down 12%, and all other segments have remained flat or improved. And 45% of revenue is from domestic ICE two-wheelers, so which means almost implied decline will be 25% sequentially for domestic two-wheeler ICE. So from that angle, sir, I was trying to understand.
Sorry. So the two-wheeler industry sequentially from Q2 to Q3, there is a loss of about 66 crores.
On a base of, sir?
Q3 to Q2, on an overall base of Q2, how much was the Q2 base? About 250 crores.
Okay, so that more or less that 25% number which I said is roughly around that only. So what's your view on that 66 crore revenue loss, normalizing that, and as you said, OBD to norm. So any idea on the price hikes or what are the changes, what you will cater to that change as such? As you said, there can be some inventory destruction, if you can highlight of that.
I don't expect any recovery in Q4 on domestic two-wheeler front. That is continues to be the thing, and I said that added to the normal challenge, this inventory correction is also expected to happen. So Q4 domestic two-wheeler industry, at least in our view, will continue to be underperforming. So we do not expect any big change compared to what we have in Q3. And there are, I am not aware of any of the price increases that are on the cards, except for any change in, because of the OBD2, if there could be, but I am not aware of that process.
So good part I can see in your numbers is gross margin has improved, maybe because of raw material benefits. So prime margin reduction was because of revenue being down. So as your revenue recovers, the margin automatically should come back. But one thing despite revenues being down, the variable part in other expense and employee cost, your absolute other expense did not come down. So maybe this new plant fixed cost added on to that without revenue. Maybe that's the reason.
Because you want to say?
Sorry, could you repeat that, Vasu?
So just wanted to understand why revenue is down sequentially 12%. Both staff cost and other expenses were steady sequentially, as a big part of other expenses can be variable in nature with volume, but other expenses were steady QOQ. So is the assumption right that the new aerospace defense plant peak cost picked up where revenue ramp up is yet to happen? Is that the reason?
So some of these costs are fixed and some are variable. So as you mentioned about staff cost, is largely fixed. The workers cost or the contractor side of wage cost is a variable portion which moves with the volume from period to period. But many of the costs are fixed, and yes, this will reflect as a better percentage when the volume comes back in the next quarter.
Sure, sir. And any new major order additions to highlight overall business?
Yeah, overall there is traction. There is orders come from both defense as well as aerospace. We have also got, as I explained, we have also added a lot of aluminium forged components across the sectors and across the customers as well. There are total now 58 components that are under PPAP and under development on aluminium, which includes both domestic and export businesses, and also both two-wheeler as well as passenger vehicles. So there is a good traction on that. There is no one such big orders, but there is a lot of orders from all the sectors.
Okay, thanks.
Thank you, Basu.
Thank you. Any participant who wishes to ask a question may enter star and 1. The next question is from the line of Akshay from Anand Rathi. Please go ahead.
Hi, sir. Good morning. Thank you for this opportunity. So a couple of questions from my side. Sir, in the opening remarks, you mentioned that you would be supplying 1 million connecting rods for Tata Motors in the next year. So just wanted to ask, so would this be for what segment would this be for passenger vehicles or commercial vehicles, or what would be the and is this a new order, sir?
Yeah. We Tata Motors is new customer for us, where the business started in the towards the end of Q2, and further got volumes have started getting stabilized in this quarter as well. So going forward, we have started manufacturing one particular model which is for passenger vehicle, and we are expected to make another couple of them, but that is yet to start commercial production. So this is mainly for passenger vehicles, yes.
And sir, what would be the approximately share of business as of today with them?
I think what I am told is about 50% is the share of this that we are looking.
Okay. So lastly, on North American orders, you also mentioned that the traction has been good towards the export side. Demand has been robust in North America, and some time back we were planning to set up a plant in North America. So are we still on track, considering we have new orders? So would we still be going ahead and setting up the plant in the next financial year itself, or would take some more time?
It won't happen in the next financial year. We are evaluating. Initially, our strategy was to look at a greenfield project coming up with our own facility. But considering the kind of availability of manpower there and other challenges, upon a detailed review that I spent almost close to a month traveling across various potential sites that we have had, we probably are looking at a slightly different strategy to begin with. We will probably lease a facility and start, part of our machining operations and assembly. And later on, as we establish, we gain knowledge on the local listing, we will start looking at putting up our own facilities. So initially, it would be a leased manufacturing facility that we are planning to set it up, and then later on we will move towards our own facility. So that this won't happen. This is likely to get finalized towards the end of this financial year. Not this financial year, end of coming financial, towards the middle to end of next financial year.
Okay. Sir, and this facility would mainly be towards the passenger vehicle segment. So considering you have orders in the aerospace and defense market, like where you supply to Collins and Boeing and the other players, so will this facility also be a direct supplier to these for this segment for aerospace and defense?
No, basically, see, I can't comment anything on defense as of now, because defense is very, very geography sensitive and very specific to each country. There is a lot of restriction on, exporting and importing on defense. So I will not comment anything on defense as such. But there are opportunities both in passenger vehicle, non-auto stationary engines, bigger, earth moving and kind of big engines. There is a huge potential there. There are orders also in that for us. There is also off-road customer with whom we are working. There are opportunities to work with them. Also XCV customer with whom we have started our relationship. So overall, this would be a manufacturing facility primarily focused on auto and non-auto, excluding aerospace. Now, aerospace, I don't see with the current mix of our products anything we will do in US. But you never know. We are also contemplating on opportunities which are there in other sectors as well. So to begin with, it will be primarily auto.
Got it, sir. That's all from my side, sir. Thank you so much and wish you all the best.
Thank you, Akshay.
Thank you. Anyone who has a question may enter star and 1. The next question is from the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. Just one follow-up question on RM cost. So this quarter's revenue growth of 16% is after factoring in for impact of the RM cost deflationary impact, right? That impact would be what, about 2-3%?
Yeah, because everything that has been, all the material cost, there has been a reduction in the material cost in the quarter, which has also been fully accounted for. So we don't have any of the pending raw material adjustments to take place. So everything has kind of now come into the system.
So the impact would be just about 2-3%.
Yes.
Mm-hmm. Got it. Okay, great. Thanks and all the best.
Thank you.
Thank you. Our next question is from the line of Abhishek Dave from Bright Securities. Please go ahead.
Hi, am I audible?
Yes.
Okay. I wanted to ask,
wanted to understand what would drive the growth in FY24 and your guidance for the same.
As I said, look, we are expecting the domestic industry, both passenger vehicle and two-wheeler, would have an industry growth between 5 and 7% is what the consensus as of now is. So if you look at that way, Sansera, we have always maintained that we would be doing at least 10% better. And we have a very strong order book where our execution of the projects is also going to happen. So I expect a good healthy growth, at least 10% better than the industry growth, which normally is what we have been maintaining. So I don't think we are still yet ready to give you any guidance for the full year. This is a work in progress that we are still on, because there is a lot of requirement, indications, predictions, consolidation is happening. But I would say that primarily we will be whatever businesses that have started, whether it is in XEV two-wheeler in domestic, aluminum components for exports, aerospace and defense, and a couple of new projects which have started to for Europe and North America. All those things are going to consolidate and then mature into a full business year for us in the next coming year. So the sector really, I would say, the export would be back to the growing path, because after a long time we have had a degrowth in exports, are slightly flattish to very small degrowth, but that should also get settled down. So all these things is going to be positive for us.
Okay, sir. Thank you.
Thank you, Abhishek.
Thank you. Anyone with a question may enter star and 1 at this time. The next question is from the line of Kapil Singh from Nomura. Please go ahead.
Hi, sir. Good morning. Sir, first question
I'm sorry to interrupt. Mr. Singh, we're not able to hear you that clearly, sir. Can you switch to handset mode and talk?
Is this better?
Thank you.
Yeah. So first question was on the long-term vision that we have. We have a vision of having 25% of revenues coming from non-auto segment, and it is at about 12.5%, right? So just wanted your thoughts that, even if I look at order book, I think it's around 20% right now. So how are we looking to get there? Is this a new plant starting will be a key driver, or do you think some major order wins you are expecting in future looking at the pipeline? So that would be the first question. And I'll just explain the context of the question also. So basically, if I look at auto, tech agnostic and EVs, that is in Q3 already at 11%. And the longer term expectation that we have given is, I think, 15%. So is there an upside risk to this number, or how do you think about that also?
Yeah, Kapil, thank you. See, the overall, when we looked at the vision, primary objective was to de-risk our basic ICE business. So we said we'll have to grow faster in non-auto, tech agnostic, XEV segments. So overall, what we had decided was that we should get at least to 40% between the two. So broadly, we wanted 25% and 15% on non-auto and XEV and tech agnostic. While XEV tech agnostic business is relatively doing better, and we are very confident that, one of the reasons why we had taken only 15% was that we were not sure at what growth rate the industry will have in XEV. And how will we be received in the exports market on this? So while now we are quite confident on both the fronts, and as you rightly pointed out, there could be an upside risk to what we are looking at on the XEV and tech agnostic. But while on non-auto, while our aspiration is to reach about 25%, I still think that we will be able to do that, because not only from this for aerospace and defense, as well as we have very good order visibility on our off-road vehicles. But as I had mentioned some time back, we have also won order for a stationary engine application and also from the agriculture sector. So the stationary engine application has a potential. Now this is going to be for Europe region, but it has got a very, very large number potential for the North America sector, which is going to be a common engine platform. So I'm quite confident that this 25% also we will be able to achieve this target.
Thanks, sir. And secondly, could you also comment on what kind of traction are you seeing in global electric vehicle market, and are there further products under development? If so, in which areas do you think you will be successful, or you're trying to be successful?
Of course, as I said, that our focus has been on lightweighting, especially aluminum forged and machined components, and also on some special steels which have higher strength, higher this thing. While I said that, but then we have also, after we have started interacting with customers, there is several opportunities which are presented to us in forged and machined category itself. We are now working with global OEMs, EV North American based OEMs, where we have developed some very critical forged and machined components which are part of the seating system, which are part of the door assemblies. But these components are very, very critical in terms of forging profile and shape and accuracies. So we are also working on motor and rotor shafts. Very complex machining is involved. There are parts which are related to suspension, chassis parts. So while lightweighting is a primary theme on which we are working, but while we are now working with these customers, we are also presented with our steel and steel forged and machined components. So we see a lot of potential here. So there is quite a good mix of both precision forged machined steel parts as well as upcoming aluminium components as well.
Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question. I now hand the floor back to Mr. B.R. Preetham for closing comments. Over to you, sir.
Yeah, thank you everyone for your participation in this call. While we strive to better our performance and meet all the expectations, we are also looking at very strong FY24 with a bounce back from our exports business as well, and also strong domestic growth to continue. So Sansera, at Sansera, we are also focused on whatever objectives and goals we have set. We are progressing towards achieving that, and hopefully that while we are going to meet you next time, we will have much better news on our order book. We expect to get stronger response in all the sectors as well. So with this, thank you very much for your patient hearing, and we will be there. For any of the doubts and questions that you may have, you can either directly contact us or contact us through our IR team of SGA. Thank you very much.
Thank you, members of the management. On behalf of Sansera Engineering Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.